Hi everyone. For this lecture video, we will be talking about the requirements of PAS 23 under the borrowing cost. So let's first have the definition of a borrowing cost. For us to know that this is a borrowing cost, so first it should be directly attributable cost. But take note, there are three kinds of transactions that you should be aware of when we are going to discuss DAC. Okay, so first, for us to consider it a directly attributable cost with respect to PAS 23, it should arise from the acquisition. Then second, it should be from the construction. And the third one should be from the production. But this is not acquisition, construction, and production of any assets. The assets that we will be talking about here, this should all be related to the qualifying asset. Let me just correct my spelling. Qualifying assets. Okay. So actually, PAS 23 specifically states the definition of a qualifying asset. So take note that when we say an asset is to be qualified, okay, it should be have or it should be accomplished to take a substantial period for it to be ready for its substantial usage, okay, or for its intended use. So it will requires substantial time period for its intended purposes. So the qualifying assets that we will be talking about here, for example, we will have an inventories, but take note, an inventories that will take a longer period of time to produce. Okay, so example of the qualifying asset inventories, but it should be longer to produce. Then we have here the PPE for obvious reason, the reason why it's in the classification of non-current asset because it will be qualified or it will be determined as a qualified asset. Then the third one will be the investment property, but this investment property should be under the cost model and of course the intangible assets. So if the asset that we will be talking about will not be produced, will not be constructed, or will not be acquired for a longer period of time, then it will not be going to defined as qualifying assets. Now that we have talked about that qualifying assets and the directly attributable attached to it is related to the borrowing cost, so eventually all of the directly attributable costs should be capitalized from or capitalized to the cost of your assets. Okay? Then other borrowing costs is directly expense. So first, if it's directly attributable cost, then it should be capitalized. But if the borrowing cost is related to the other cost that is not under the PAS 23, then that should be expense outrightly. Okay, so let's establish what are the direct attributable costs under PAS 23. Okay, so we have two kinds of costs here. We have the interest, but take note, this is related to the interest expense on financial liability or financial liabilities. But take note, if there are other types of liabilities, for example, lease liabilities, that is being measured using effective interest rate method. Okay. So again, the first thing that you should be aware of as borrowing cost is the interest expense. It can be related to a financial liability or it can be related to a lease liability. But take note that for both financial liabilities and lease liability, it should be measured using the effective interest rate. Okay? So if it's not under the effective interest rate, then the interest expense that we will be talking about is um, not to be considered a borrowing cost, not to be considered a capitalizable cost under PAS 23. But it will be considered as borrowing cost, but it will be recorded as an outright expense. The second one that we should be aware of as borrowing cost is we have here the foreign borrowings. But under the standard, not all foreign borrowings should be capitalized. Okay? So this is related only to the foreign exchange or forex. Okay? So the foreign exchange that are regarded as adjustments to interest cost. Interest cost. So these are the two borrowing costs that you should be aware of. First is that we have the interest expense from the liabilities. So it can be, again, a financial or a lease liability. But take note, the standard is very specific for us to only include the effective interest rate method under PAS 23. Then we have here the second one, which is the finance cost of the foreign borrowings. Okay? So basically, borrowing costs do not include actual or imputed cost of equity or capital. Okay? So primary exclusions or exclusions with S is that it should exclude or do not include actual or implied expense on equity accounts. So if you will notice, all of the accounts that we will be talking about as part of the borrowing cost is always from or always be coming from the liability and will never be coming from the equity portion of our transactions. So that's why for the qualifying assets, we will not going to include the financial assets. Okay? So financial assets will never be considered as qualifying assets. But, okay, for the inventories, PPE, investment property, and intangible assets, those four, for as long as they will be acquired, constructed, and to be produced in a long-term basis or for a long time period, then those will be considered as qualifying assets. But the financial assets, okay, the inventories, but take note that will be inventories that will be produced for a short-term basis will not going to be qualified as a qualifying assets. Then all assets, okay, all assets that are ready for sale or ready for its intended use will not going to be considered as a qualifying assets. Then this is the most important one, all assets to be measured under the fair market value or at fair market value. So that's why for the inclusions, again, the main criteria that you should be looking at is that it is first, or I'll just write here, criteria. The time period that we are talking about is longer. And for obvious reason, the assets, not the current, the assets that we are talking about here are non-current assets. And for us to include it as part of the qualifying asset, then it should be measured under the cost model. If the assets will be produced, constructed, or acquired on a short-term period, classified as current asset, then to be used or to be measured under fair market value, then those are the exclusions. Okay? So again, the criteria for the qualifying asset will never be in conflict with the criteria of current and non-current assets and liabilities under the PAS 1. Okay? So no accounting standards provision that will be in conflict to other accounting standards. So let's talk about here the concept of capitalization. So concept of capitalization. So actually, when we say that the borrowing cost is to be capitalized. So first, if they are avoidable, okay? The directly attributable cost or the borrowing cost is avoidable, okay? So for example, the expense that we will be talking about, um, you cannot incur it if the qualifying asset had not been made, okay? So it will be capitalizable. So basically, if the specific borrowing cost or if the specific expense is unavoidable, then that is one of your sign that the borrowing cost is non-capitalizable or an outright expense. Again, the borrowing cost that we will be talking about here will be coming into two. It will be capitalizable and it will be not capitalizable or an outright expense. So the capitalizable one is first, it should be avoidable. Then second, it should be longer or it should require a longer time period to acquire, produced, or constructed. It is related to the non-current asset and you are using cost model approach. So let's first have the timeline for the capitalization. So first, for us to consider that the borrowing cost will your this is the inception or the start for you to record the borrowing cost. So first, all of the expenditures for the assets are being incurred. Okay? All, so meaning to say, you have started the um, acquisition stage of a specific asset. Okay? Then the second one is that the borrowing costs, which are capitalizable, are being incurred as well. Okay? So borrowing costs are being incurred. So what do we mean by this one? It should be interpreted as the liability portion that you will going to use to acquire, to construct, or to produce a specific qualifying asset is that the borrowing cost will also be incurred on the same day. Or actually not on the literal same day, but on the incurrence of the financial liability that we will be talking about. Then the last one is that for you to consider or to start accumulating the borrowing cost is that the all of the activities necessary for you to place the sale or the intended usage of the asset is now being undertaken. Okay, so assets are being sold, or it is being prepared for its intended use. Okay? So take note that one of the inclusions of a capitalizable borrowing cost is that the moment that the assets are being ready for sale, so that's the time that the borrowing cost will not be recorded as capitalizable. Okay? So maybe let's have an illustration for this one. Let's create a timeline for this. So let's say the one in with star, this is the inception of our all the expenditures, all of the financial liabilities. Then we have here our line, our tick line. This is the point wherein the assets will be readily for sale, ready for sale, or ready for its usage. So all of the cost from the star up to the orange line will be capitalizable. Then all of the highlighted area from the orange line all the way or beyond the orange line will be an outright expense. Or simply put, this is also the exactly same timeline that you will be observing under the past 16. Because under the past 16, all of the costs that you will going to incur up to the moment that you will use a specific asset, then all of the directly attributable cost that is coming from that point will be capitalized as well. Maybe we can talk about examples of necessary activities that we will be including as part of the capitalizable cost. So first is that for obvious reason, we will going to include as part of the directly attributable cost for the borrowing under past 23, the actual, first is the actual physical construction or construction cost. So for obvious reason, because you're going to include the cost from the construction as well. Then of course is that please be careful with these guidelines. If the technical and administrative work. So let me just write it here. Technical and admin works. Okay. arises prior to the start of the physical construction of the asset, of the qualifying asset, then all of those kinds of activities will be considered as part of capitalizable borrowing costs. Okay? So let's be careful with this one, because for the technical and admin works, we're not going to look for the indication that that the qualifying asset is ready for sale or for usage, but we will only look for the timeline wherein the physical construction will not going to happen yet. Okay? Let's say if the physical construction, let's have a new timeline for this one. So let's say the physical construction will happen at this point. So it means to say that the areas highlighted in green, all of the technical and admin costs here should be capitalizable. But the moment that the company, or the moment that the qualifying asset started, oops, let me just correct it one, started its construction, okay, all of the areas in pink will not going to be capitalized. Okay, so again, there will be two timelines that you should be aware of for the borrowing cost. So the first one is that the moment that it is ready for use, then you will stop accumulating all of the directly attributable costs. But with respect to the technical and admin work, the moment that the construction will physically start, then that's the end of your capitalizable technical and admin work. So basically, what you're going to do is that if there will be no production, or if there will be no production or no development on the activities with respect to the construction production, no borrowing cost to be capitalized. Okay, so we have here the formula that we will going to use for us to determine the capitalization requirement. So take note that first is that we should be familiar for the specific borrowings. So when we say specific borrowing, so the definition is quite straightforward for this one. This is specifically for the purpose of obtaining the qualifying asset. Okay? Specifically for the acquisition. So when we say acquisition here, this is the manner on how you obtained the qualifying asset. So let's have here the formula or the capitalizable borrowing cost for this one. So we have the capitalizable borrowing cost. That is the summation or the total of, okay, then we should be able to reduce the actual borrowing cost to the investment income. So that is the total capitalizable borrowing cost. Okay, so let me just box it in orange, okay, for you to have a summary on the formula. So let's say that the interest expense on specific borrowing. So so let's say we have here 1 million pesos multiplied by the effective interest rate is 10%. So we have here 100,000. Then the investment income from the specific borrowing, you're going to deduct it to the interest expense. So let's say hypothetically we have 20,000 pesos. So meaning to say our capitalizable borrowing cost will be amounting to 80,000 pesos. Capitalizable capitalizable borrowing cost. Okay, BC. Okay, so let's have here the journal entries for all of these. So for the interest expense, so we have here, we're going to debit interest expense and we're gonna credit cash 100,000 pesos. Okay, then for the investment income that we received from the borrowing cost, then we're going to debit cash. Then we have here investment income, 20,000 pesos. Then the last one is that we're going to add whatever will be the net of the interest expense and investment income. Okay? So we're going to add it in the building. So debit building, since the interest expense is larger than the investment income, so we will credit interest expense, 80,000 pesos. So this will be your journal entries with respect to the specific borrowing. So now let's go to the general borrowing. So when we see general borrowing, so these are obtained for more than one purpose. Or basically, this is obtained not for a specific purpose. So maybe they will obtain it for the acquisition of a specific asset, or maybe they have just get the loan from it, but not specifically for the purpose of construction or acquisition of a qualifying asset. Okay? So basically, this is for general purposes. So if you encountered a problem, then the borrowing will not going to specify that is it is for the specific qualifying asset, then you should consider it as part of the general borrowing. If it's not for the specific borrowing, then it should be understood that we will get its own capitalization rate. Okay? Because all of the expenses that are specifically for the acquisition of qualifying asset, all of those will be 100% capitalized to the qualifying asset. But if we are going to use a general borrowing, then we should be able to determine first how much is the capitalization rate. And we're going to multiply the capitalization rate on the average expenditure because the expenditure will be evenly spread out throughout the construction unless otherwise stated. So that's why if it's evenly spread out, then we will see that there is an average amount to be used for a specific type of expenditure. But if it's not average, then you're going to use the weighted average one. So capitalization rate multiplied by the average expenditure. Then you can get your borrowing cost, but for the general purposes. Okay? So we have here two formulas, the general borrowing and for the specific borrowing. Okay? So let's first have the question for or some hypothetical question regarding the general borrowing. So, for example, we have here 10% short-term loan amounting to let's for simplification purposes 1 million pesos. Then we have here 20% bank loan. Then this is amounting to 10 million pesos. So the amount that we will be talking about here is simply just the amount for the construction and for the production of the qualifying assets. But take note, these are all general transaction. So let's say that your total here is 11 million pesos. Okay? So the next thing that you will going to do is that, so maybe let's try to have different months for this one. Okay? So let's say that the expenditure for this one is let's say for January 1, we have here 1 million pesos. Then coming June, or not June, but maybe we can try October 1. Okay, October 1, let's say 500,000. Okay, then we should be able to get the number of months outstanding for this one. So I'll just go straight to the point. So starting from January 1 until December 31, so it means to say that the 1 million pesos has been outstanding good for 12 months, and the average expenditure is 1 million. Then for the 500,000, since we're going to count starting from October, November, December, so that's 3 over 12. So we have here 500 multiplied by 3 divided by 12. We have here 125,000. So our total average cost will be 1,125,000 pesos. But take note that you're not going to get the average of the one in yellow box. Okay? What you're going to do is that get first the interest, then divide it to the total general borrowings. Okay? So the interest for this one is we have here 1 million multiplied by 10%, and that is 100,000. Then 10 million multiplied by 20%, then that is 2 million pesos. Okay? So in total, the interest will be 2.1 million pesos divided by 11 million. So 2.1 divided by 11, we have here 19%. So if you will notice, if you're going to average the 10 and 20%, so 10 plus 20% divided by 2, you're going to get 15%. So sometimes it will be way lower, or sometimes it will be way higher. Okay? So the 19% here, you should be, this is the capitalization rate that you're going to use. So that is 1.125 million pesos multiplied by 19%. So 1.125 multiplied by 19%. Then we will have here 213,750. So the amount of borrowing cost that you should be aware of is 213,750 pesos. Our journal entry for this one is debit building or debit asset or debit qualifying asset. So again, a qualifying asset, it can be inventories, but for long term. Then it can be building, land, etc. And not land, because you cannot construct a land, but the land should be acquired. Then land, building. Then we have here the investment property, but under the cost model. Okay. So qualifying asset debit 213,750. Then we will have a credit of interest expense 213,750. Actually, this is the in this theoretical example, this is an application on how you will get the general borrowing if this is uneven. But again, if all of the expenditures are even, okay, so just get the um, total amount that you should going to have a borrowing. So if even, then you're going to get, for example, this is 20 million pesos, then you're going to divide it by 2. So that will be 10 million pesos on average. The 10 million pesos should be multiplied to its respective capitalization. Capitalization rate. So the key takeaway here is that you should first get the difference between the intention of a specific borrowing. So if it's specific, then it should be specific for the construction or acquisition of a qualifying asset. Then if it's not specific, then it is general. Okay. So for the specific, again, the formula here is that your actual borrowing cost, you will going to deduct the investment income. And for the general borrowings that you're going to have or to compute for your capitalization rate, then multiplied by the average expenditure. Let's say we have a problem that considered both the specific borrowing and the general borrowing. Then we're going to deduct the specific borrowing. Again, we are not talking about here the borrowing cost, but we are talking about here the amount of the principal. You're going to get the average expenditures that is related to the general borrowing. So basically, when we say average expenditure, there is a component there that is specific for the specific borrowing cost. So you're going to deduct first the specific borrowing before you will come up with the average expenditure for general borrowings. Okay? So we have here the average expenditure for general borrowing. Okay? Then whatever will be the amount for this one, we're going to multiply it to the capitalization. But the capitalization rate that we will going to use here is related to the capitalization rate from the general borrowing. This is less, then this is multiply. Then whatever is the amount that you will get here is the borrowing cost for total borrowing cost, but for general. Then for the specific, same formula for the specific borrowing. So again, our formula here is that we have here the interest expense. But take note, it is based on the effective interest rate or using specific borrowing SB. Then you'll reduce it by the interest income. Then you can now compute for the borrowing cost, total borrowing cost, but that is only related to the specific. If you're going to get how much is the total borrowing cost for the qualifying asset using the general borrowing and the specific borrowing, you have to combine the two. Then you will get the total borrowing cost. All right. We are done discussing the traditional method. Now let's have the new method under PAS 23, which is the avoidable interest method. So take note that when we will be talking about the avoidable interest method, what we will only going to include is that we're only average only the expenditures that is related to the general borrowings. So let's have an hypothetical question from this one. So let's say that the average expenditure is that we have here 1 million, then we have here 2 million, then we have 1.5, then we have here 3 million. Okay? So let's say that the 1 million pesos is that we have here specific and we have here general. Since we are going to use the average or the avoidable interest method, we are only focusing on the amount that will be recorded in the column of the general. So those are the amounts that you will going to average. It's either you will use the divided by 2 if the expenditure is evenly distributed, or you're going to use the weighted month average. So let's say that the 1 million pesos is that 800,000 is from the specific, then 200,000 is from the general. All of the 2 million is general, 1 million for the specific, then 500,000 for the general, and all 3 million pesos will be general. Okay? So you're going to multiply it to the number of months outstanding. So for example, this is just an hypothetical one. So this is 12 over 12, then it will be 9 over 12, 3 over 12, or this will be 1 over 12. then whatever will be the amount that you're going to get, that is your average expenditure. So let's compare the average expenditure to the traditional expenditure. What you can see here is that average expenditure, you're going to deduct all the specific borrowing. So basically, it's the same thing for the traditional model and for the avoidable interest method. So basically, the capitalization rate, the formula for that will exactly be the same, but you have to remember that only the specific borrowing is to be excluded if you're going to use the avoidable interest method. Okay? So the basic difference here is that you're going to watch out for the specific borrowing component of this full amount. So that's the main difference between the traditional method and the avoidable method. Let's have a summary on the formula for that one. Then for the traditional method is that we're going to get the total borrowing cost. This is under the general by having the total average expenditure. Then we're going to deduct the specific borrowing. Then before you will multiply it to the capitalization rate. Whereas for the avoidable interest method, you're going to get the average excess expenditure. Total borrowing cost is that it is equal to the excess of average expenditure. Then you're going to multiply it to the capitalization rate. So this is your formula for this one. So let's try to discuss the limitations for the expenditures. The expenditures, it is not always given, but you should have or you should be able to keep in mind that there are some items that you should not be going to include as part of the expenditure. Okay, so let's only discuss what are the inclusions of expenditures. So first is that if the expenditures is a result from the payment of cash. Okay? So cash payments, all cash payments for the qualifying asset is to be recorded as expenditures. Then the second one, transfer of other assets. The third one is that you're going to assume an interest-bearing liability. So these are the three amounts that you should be able to include as part of your expenditure. All of this, we have here a reduction. Okay? So expenditures will be reduced by any progress payments and grants. Okay? But take note, it should be connected from the assets. It should be connected from the qualifying assets. Get the total of this one to get the total inclusion. Then we have here the reduction. We have here the progress payments. And we have here the grants. Take note that it should be attached, both of these should be attached to the qualifying assets. Then that is how you will going to have your total for the reduction. And by subtracting the total inclusions to the total reductions, then we should be able to get the net inclusions. Of course, if the total inclusion is higher or larger than the total reduction, then we will get a net inclusion. But if the total reduction is is larger than the total inclusion, then we will get a net reduction to expenditures. Okay, so those are the things that you should be aware of. So let me just clarify the definition of the progress payment. So when we say progress payment is that these are the billings that you have been collected. So for example, we have here example for 600,000 pesos. The date of billing for this one is or happened in September of the current year. Then the date of billing. Then we have here the date of collections, November 1 as well, current year. Okay, date of billings collected. So for the date of billings collected, kindly take note that let's say that for the 600,000 pesos, we're going to count from November, sorry, not November, we're going to count from September, October, so that's 2 months. So that will be 2 over 12, or 600,000 multiplied by 2 over 12 is that. So we have here 100,000. This 100,000 pesos will be the average that you're going to reduce the total inclusions. Okay? So this is your average reduction. So that is the meaning, or that is the definition of your progress payments. Okay? Let's talk about the presentation and disclosure requirement under the PAS 23. So take note that the only asset that we will going to talk about for PAS 23 is all the qualifying assets. Let's have it here, qualifying assets. Now, qualifying assets are not segregated from other assets. So meaning to say is that, okay, so meaning to say they will be presented as regular asset under their normal classification. So for example, the qualifying asset is a PPE, then all of the qualifying asset will be reported under the total PPE. Okay? And they will not be presented separately, nor they will not going to be segregated separately. Okay? So let's say we have here the total PPE. Let's say we have here 1 million pesos. Then 20% is a qualifying asset. Then the remaining 80% is a non-qualifying asset. Okay? So for the qualifying asset, you will follow the requirement for the past 23 with respect only to the borrowing cost. Okay? But for the 80%, you will follow past 16. Okay? The requirement for the directly attributable cost attached to past 16. So again, for the borrowing cost, we are only concerned first on the interest expense and to the finance cost. Okay? So for the directly attributable cost for a qualifying asset, that is under past 23. Then for a directly attributable cost under a non-qualifying asset, you will use past 16. That's the end of the video for the borrowing cost. Thank you for watching.